The Toronto real estate market may be coming to a screeching halt. With the recent rate hike and possibly another rate hike coming next week, the rest of the year may be looking a little bleak. Hello everyone, this is Sid Sur from Sid Sur Real Estate, helping clients with buying, selling, leasing, investing, as well as platinum access to pre-construction condos. If this is your first time on this channel, please go ahead and hit that subscribe button for all things real estate. So the Toronto real estate market was actually looking pretty good for the last few months. Starting from the beginning of this year, we saw month over month price increases in April, and I was seeing flashbacks of the peak of the market back in May and even April. As soon as the Bank of Canada decided in March to pause their rate hikes, we saw a crazy increase in activity. Prices were going up. Bidding wars were back. We saw multiple offers on properties. Showings on our listings were going crazy. Buyers were getting frustrated again. And once the bank did another rate pause in April, we started seeing even crazier activity. A lot of people thought the market was back and we were at the peak again. And of course, sellers were incredibly happy with the sale of their homes. And then as soon as the inflation numbers came in from April, which ticked up to 4.4%, the Bank of Canada said, whoa, we got to slow down. Let's do a rate hike, and rate hikes came back again. And with that, consumer confidence really dipped. The Bank of Canada decided to do a 25 basis point increase, and this just really goes to show that any kind of news and obviously rise in interest rate really brings down consumer confidence a lot. And when consumer confidence comes down a lot, not to mention we also had the elections that were happening during that time in June, we saw an incredible slowdown in activity. So I'm going to get into the June numbers right now with you guys. So in June, the average sale price is $1,182,129, which is actually a $13,000, almost a $14,000 decrease from last month, or a 1.2% decrease month over month. Now, this is the first month over month decrease that we've seen so far. However, one asset class did go up, believe it or not, and that was a semi-detached, which actually went up by $16,687,000. So another reason for the slowdown in sales activity is due to the fact that one thing I already talked about, which was the consumer confidence, but also a lack of inventory. When you have a lack of inventory and buyers don't really have a lot of choices, you can't really buy what you can't find. So due to that lack of options, buyers have decided to go back to the sidelines. Now, if you're sitting there all grim and hoping for some positive news, I do have some. Year over year, prices have actually gone up by 3.2%. Look, if you know me, then you know that I don't believe in trading real estate on a month-over-month basis. Nobody should be looking at real estate on a month-over-month or even a 6-month time frame. Real estate should always be looked at from a long-term lens. If you bought real estate last month, you're most likely not going to be selling it a month later. If you look at the last 5-year, on a 5-year timeline, properties have done incredibly well. I've got some numbers right here. Detached homes have actually appreciated $497,000. Semi-detached over the same time period have gone up by $410,000, townhomes by $395,000, and condos by $178,000. So whenever you're looking to get into the real estate market, whether you're a end user looking to find your dream home, or you're climbing up the property ladder, or you are an investor, you always need to be looking at real estate from a long-term lens, because long-term, we are going to get out of this mess and you are going to do really, really well. And look, you might be thinking, well, how come values haven't dropped that much? Well, there's one simple reason we have not seen values dramatically decrease year over year, despite the crazy higher borrowing costs and rate hikes, and that is supply. We are absolutely undersupplied here in the GTA. There are a lack of homes. We also have a very strong and resilient market. Delinquency rates are very low. Banks are working with borrowers to make sure they don't default by extending amortizations. Yes, they're not paying pretty much anything on principal, but they get to keep their homes. Now, here are my thoughts for what I believe is going to happen for the rest of the year. If the Bank of Canada decides to do another rate hike on June 12th next week, which after having spoken to a lot of mortgage brokers, I'm getting the consensus that they are going to do another 25 basis point increase, I think we're going to see a pretty slowdown in activity, and values for the most part I feel are going to pretty much remain stagnant, or if anything, just probably dip down a little bit. And the reason for that, again, is supply. There's just not enough homes. The population has been growing exponentially. There's a lot of demand, but not enough supply. Also keep in mind that we are in the summer months, which have traditionally always been a very slow time in real estate. The last few years, summer months have been extremely active because they've just been a complete anomaly. Traditional real estate markets, we have the spring market and then we have the fall market. There's barely any activity in the summer and winter months. I mean, sure, there is activity, but not at the scale of the spring and fall markets. I do think that the fall market is going to be pretty stagnant if there is another rate hike. We are going to see sales activity, but I think year over year values are going to stay pretty much more or less the same, maybe even go up a little bit. Again, remember, when rates went up last year, they started going up dramatically. And that's when buyers completely went to a screeching halt and everybody was in panic mode. And we saw a pretty dramatic decrease in prices at that time. But year over year, we have recovered. So I think for the rest of the year, we're going to see pretty much a lull, but no dramatic decreases in prices. If you're expecting for a crash to happen, I highly doubt there will be one. Again, the market's too resilient. We have too much demand. And for those wondering, well, what about the people whose renewals are coming up? Well, look, people that have renewals coming up in 2023, 2024, they had 5-year fixed mortgages that they got back in 2018 when rates were still around that 3 to 4% mark. So their payments aren't going to dramatically increase. People who lock down a 2% or even sub 2% interest rate are not going to renew until 2025, 2026, which again, most economists believe the rate should be coming down by then. They probably won't be going into that 2% range again, but likely around the 3.5% mark. So guys, I hope you found this video helpful. If you did, please go ahead and give it a big thumbs up. And of course, please let me know your comments. What do you think is going to happen in the Toronto real estate market for the rest of the foreseeable future? And once again, don't forget to subscribe. Thanks for watching. See you guys in the next video.